Brexit. There's a lot of noise being made about it, and that noise is becoming increasingly louder. Ken Veksler, Accumen Management. The week started with a speech from Germany's finance minister. Following that, we see Germany's unemployment data on Tuesday. Ken, how much of a reflection will this data release have on the overall health of Germany and the euro area?
What we're generally seeing is some element of a plateau as far as data getting any worse. I think it's a long time yet before we see a real sort of spike higher and a reversal of recent fortune. But having said that, data overall seems to have leveled off somewhat, and incrementally it's not really getting much worse than it has been. So that in itself is probably a relatively positive sign. Whether the rest of the market sort of foresees it in that light is probably the more important question. And right now, the answer is likely not. There's not a whole lot of objectivity with regard the quality of the data. So obviously, any positive surprise better than market expectations will always be seen as a good thing, but perhaps not to its fullest extent. And as far as and overall, what sort of reflection this means for the health of the euro area, as I said, basically, I think we're sort of reaching not a bottom as such, but certainly leveling off. So that in itself should mark some sort of positivity. But of course, all eyes now will be on the next ECB meeting on the 10th of March, and even more so, what sort of commentary and rhetoric we'll be hearing out of the various finance ministers as well as central bankers, be they German or ECB based. So that will be quite telling, given that Draghi has already hinted at the last meeting that there will certainly be more action from the central bank come their next meeting in March.
Following David Cameron's meeting with EU President Donald Tusk, investors are starting to focus on risks of a potential Brexit. Looking ahead to Thursday's Bank of England interest rate decision, are you expecting to see a more responsive sterling this week?
The topic of Brexit is certainly becoming far more prominent. There's a lot more noise being made about it, and that noise is becoming increasingly louder. What we need to be wary of is falling into the trap of predetermining when and how that vote will actually run. Right now, there's a bit of speculation about the fact that the vote could come as soon as June of this year. It's probably a little premature, but it certainly does speak volumes of how the market is perceiving it, in that sort of the tail end of last year, even November, December, it was on the horizon, but it wasn't particularly prominent in the minds of investors and traders. And I certainly believe that as time goes on, so in the next month, 2 months, we'll be hearing more and more of it. And that in itself will keep some element of downward pressure on the sterling. As far as this week's meeting, look, I don't think anyone really expects the Bank of England to move on interest rates. There will be focus certainly on what the vote count will be like, what the split will be, whether it remains at 8-1, moves to 7-2, or potentially even goes back to 9-0. I think reality says that we'll stay at 8-1. The rhetoric that accompanies it will be of interest, but given that we've also got the quarterly inflation report on the day, there'll probably be a little bit more focus on the bank's perception of where and how inflation will be moving in the next quarter or so, and that in itself will guide policy in the near term as far as interest rates are concerned.
Now looking at the end of the week, potentially positive US non-farm payroll figures may highlight the chances of a Federal Reserve interest rate hike in the near future. In your opinion, are the results looking to be positive, and what correlation could they have on the US interest rate hikes?
The market is pricing in probably a result that comes in line, so somewhere around the 200k mark. A positive surprise would have initial implications for where and when the Fed moves next. But truth be told, the market, given the recent spate of other economic data out of the US outside of non-farms and employment, the market has slowly been discounting even further the chances of the Fed hiking now in March. Bottom line is, my personal view is that a March hike is more or less off the table. And if we are to see a move north in the Fed funds rate, it probably won't come before the end of Q2 this year. Obviously, a better print in the unemployment numbers and general employment situation should give the Fed a little boost in the arm. But having said that, the ECI data that we saw last week remains relatively flat in that it's moving along, but it's not doing anything amazing, and that in itself is keeping the wage inflation aspect of the overall inflation picture relatively steady. So for the interim, I think the Fed sort of remains sat on hands, and even if we get a stellar number come Friday, I think that in itself will be taken with a pinch of salt in due course, because ultimately there's other data that plays a fairly significant role in the Fed's decision-making process with regard rates.
Well, Ken, thank you for your insights, and thank you for watching. It's only the start of this trading week, so do keep clicking back to see how the markets play out. Goodbye for now.